So one of the good things about Chapter 9 to begin with is that we're going to cover something that's not really heavy on math. But there's a couple of different things I want to point out here. You probably want to spend some time listening to the podcast this week and getting the stuff on the podcast. I go into much more detail there. Here I'm just going to talk about the difference between accounting cash flows. And so this is all about perspective, right? We have accounting versus financial perspective versus finance. And in accounting, we're always talking about accounting profit, and we're talking about that kind of thing, stuff out of the balance sheets. And in finance, we often think about cash flows, and this is the difference. And one of the ways to talk about that difference is to say, if I work down, let's say I make a sale of, let's say I sell, 100,000 chairs or whatever. If I sell 100,000 chairs and I get a net profit, if I get a net profit of $2 a chair, then you could say that I have made $200,000. But all of this money sits in accounts receivables until it gets paid. Accounts receivables. But at the end of the week, I still have got to pay, let me change the color here. I have to pay salaries. So I might turn to my boss and say, hey, boss, guess what? We've sold $200,000. We have an extra $200,000 in net income this month. And my boss will turn around and say, yeah, hey, that's great. Can you pay everybody their weekly salary? And the answer is no, I can't, because these account receivables have not turned into cash. And that is basically where the Chapter 9 perspectives comes from. As such, we have to consider the different types of costs that exist out there. And on the accounting side, what we're really looking at are called that's new. Okay, we'll stick with white. On the accounting side, the ones that we're really interested in are non-cash expenses. We're interested in taxes, and we're interested in not focusing on incremental cash flows. Okay, this is on our accounting. And one of the most important types of non-cash expenses is depreciation. There's a couple of others like amortization and depletion, but we're going to allow your accounting classes take care of that. What's important here is that you know that depreciation exists because actually it's going to affect some of our valuations, as you may have already seen over in our accounting, in the accounting rate of return from the previous chapter. However, on the finance side, cash flows are critically important. And so we look at cash flows and we like to label these as incremental cash flows. Incremental, which basically means, we take advantage of them one at a time or when they come up. And the first of our incremental cash flows that we're going to take advantage of, or that we're going to focus on, before I talk about net working capital, and I know I'm supposed to do that first, but let's talk about incremental cash flows, are sunk costs, opportunity costs, and cannibalization. And I'll go over these fairly quickly. Cannibalization. So make sure you have a good idea of what these are before we go into them. They're easily defined in the book. These are costs that have been paid, but more importantly, they are unrecoverable. That's terrible. Unrecoverable. They are not coming back. Unrecoverable. They're not coming back. These are expenses that have already been made. And the problem with sunk costs is that they are emotional costs. This is money that has already gone out and you've already spent it, and yet we use it to make decisions. This is money you're not going to get back. It's gone forever. And a great example of this is, Superman and Batman just came out. I don't know when you're actually going to watch this, but let's pretend I spend $20 on movie tickets, and then I find out, and the goal of my evening is to have a nice evening with my wife, right? So is a nice positive date night. And Superman versus Batman just came out, and I don't know whether or not it's good or not. Maybe I'll watch it, maybe I won't. But my students say, no, don't watch it, it's terrible. Students are like, no, it's terrible, don't go. And so now I have to consider if I'm going to, and let's say I believe them, right? So now, if my goal is to have a nice date night with my wife, should I go to the movies or should I go to dinner? Obviously, we would do both, but which one would you do? Would you go to the movies or to dinner? And many of us would turn around and say, hey, you've already spent $20 on the tickets. You have to go to the movies. But my goal isn't to go to the movies. My goal is to have a nice date with my wife. It may be, if I believe my students in this scenario, I should opt to go to dinner because the $20 for the tickets, they're not coming back. Now, obviously, you can go and ask for your money or whatever else. And I'm sure the Superman versus Batman movie is going to be fantastic. All my DC fans. I live in a DC house, so, that's we're big fans. We're going to go watch the movie, even if it's not great. Next, what we have to discuss is opportunity costs. Let me write it back down again. Opportunity costs are those costs that you would have on the next best alternative investment. So let's say you have choice A or choice B. If you pick A as your choice, your opportunity cost is the cost of B. Okay, opportunity cost is something that you discuss in many other classes. It is the idea that you choose something and whatever the other choice would have been, is the money or the opportunity that you're losing out on. It's one of the ways that we measure the way costs are taken or cash flows are being made. Finally, we're going to talk about cannibalization. With an I? Cannibalization. Cannibalization. I like to use a Coke versus cherry Coke example here. So you have Coke, and you have this whole big number of people that like Coke, right? Here's the number of people who like Coke. And Coke decides they want to come out with cherry Coke, because their research shows that there are some people who enjoy to drink cherry Coke. And so here's the total number of people who are going to buy cherry Coke. What ends up happening when you come up with a new product such as cherry Coke is that you lose this percentage of Coke. You lose this percentage of Coke drinkers now become cherry Coke drinkers. And so while we can turn around and say, hey, look, we're making a lot of money on cherry Coke because it's a new product, and it directly competes with Coke, we miss out. We are no longer taking the monies from, or the finances from, the sales of the old Coke. That's cannibalization. Cannibalization is the idea that new potential cash flows have taken new products have taken the place of our old products. Therefore, our new products are eating away at our old incomes. Which brings me to net working capital. Let's make some space here. Net working capital. Net working capital is really an important capital. It's really an important concept. And the way we calculate net working capital is to take current, I don't like that at all, is to take current assets and subtract current liabilities. Now, this looks a lot like our current ratio. Net working capital. This looks a lot like our current ratio, right? Our current ratio is equal to current assets divided by current liabilities. And this gives us some number, hopefully greater than 1.0, which then represents an ability to be able to pay our short-term liabilities with our short-term assets, those that we can turn into cash in a relatively short amount of time. So net working capital then reflects all the cash or all the liquidable assets that we have left over after we pay off our current liabilities. And net working capital is a crucial instrument because with net working capital, we can take on or pay for additional projects. When we have extra money, we can reinvest it. And that is the major point of net working capital. Net working capital gives us the value of, or gives us the amount that we can use to set up our future projects. Now, there's a very strong comment that comes up when we discuss net working capital that states, let me find it here so I can get it right. Increases in net working capital represent cash outflows. So let's think about that for a second. Increases in net working capital represent cash outflows. And at first, this may not make sense, but this is where we start working the actual net working capital outflows. And so if you're with me on page 293 in the book, you're going to see a chart that has some current assets, which include cash, accounts receivable, inventory, and then a current liability under payables, accounts payable. And so in year zero, we're going to have $1,000 in cash. We're going to have 0 receivables. You haven't sold anything yet. $4,500 in inventory and $2,500 in accounts payable. And this gives us a net working capital of $3,000. How do we do that? Well, first we kind of just added all of these up, but we can look at current assets, that's these three, and then subtract it from current liabilities. Easy, no big deal. In the next year, we have $2,000 in cash. That's great. We've actually made some sales, so we have $5,063 in receivables. We have $75.94 in inventory, and we have accounts payable of $43.74. Okay, this means my net working capital has increased to $10,283. So let's go back to our previous statement. Okay, increases in net working capital. Increases in net working capital reflect cash outflows. Now, where are the cash outflows? The cash outflows are here. Here, here, and here. What does that mean? It means I have accounts receivable means that I have sold goods, but I haven't gotten the cash back in yet. Therefore, there exists some amount of goods or some amount of inventory that has gone out. Okay? Let's forget about cash for a second and look at inventory. What does this mean? It means I have spent money to create inventory. I have spent money to create this inventory, and my inventory has increased. So while my current assets are bigger, and we would naturally think that, hey, we've got more assets, we should have more money, these represent cash outflows because they're activities that I've already made in order to create the potential of selling additional inventory. Likewise, here's my account payables. I haven't actually paid this out yet. It's how much I need to get paid for the end of the year. And therefore, my net working capital has increased from year 0 to year 1. This is the specific difference between accounting and financial perspective. Under the financial perspective, I'm looking at how this money has moved. This money has moved, or how the money has moved to reflect this. Under an accounting, that's under a finance perspective. Under an accounting perspective, this account receivable right here represents sales that I've already made. Therefore, I should have income. But this income, because it's here in accounts receivable, hasn't been received. Therefore, my net working capital, while it increases over time, actually reflects cash outflows. That's a concept that you're going to see again, I promise you. So all of this sets us up for a fundamental question, the capital budgeting fundamental question that we'll detail later. And that is, if the firm has multiple acceptable projects, and that can be either in terms of NPV or IRR or any other decision-making strategy that the firm has, why not accept them all? Why not accept them all? And there's very specific reasons for this. The first one is you may not have the money. You may not have the money to accept them all. You may not have the expertise or the people to accept them all, hence cannibalization. You may have a situation where you're outside of your core values. Okay? Coca-Cola should not be making vehicles. That's outside of their core values, outside of their core business. You know, all these other projects may exist and you may be aware of them, but that doesn't necessarily mean that they're a good idea. The one that we're going to focus on next chapter or next couple of chapters is going to be this one. If I have a limited amount of money, which projects should I choose? And we'll use both our knowledge of cash flows and net working capital, as well as our techniques in capital budgeting evaluation to make that decision.